Shalom class, welcome to your favorite channel at Innocent Mapanda Tutorials. In today's lesson we are going to focus on absorption costing and marginal costing income statement. Right, so I have extracted a question from Cambridge, November 2005, paper 2. It reads, Gary Hattrick Limited manufactures and sells video cameras. The unit selling price and production costs are as follows. So we are given the selling price, direct materials, direct labor, variable overheads, as well as fixed overheads in terms of units cost, as well as the unit selling price. Right. Then here comes another information. The fixed production overheads assume a monthly production of 2,000 units. So we refer to this as normal activity level, or we can refer to this as budgeted activity level. So whenever your question is attached with normal activity or budgeted activity level, it means there is production volume variance to be calculated, which affects the absorption costing income statement. So the production volume variance can give you an under recovery or an over recovery. Under recovery is treated as expense, or it can be added to the cost of sales. Over recovery is treated as income, or it can be deducted from the cost of sales. I hope you are following. Right. Here comes another information. The following monthly costs are also incurred. Fixed administrative overheads 80,000, variable sales overheads 10% of sales value, fixed sales overheads 120,000. Right? During the month of September 2005, a total of 2,400 units were produced, of which 1,800 were sold. There was no stock on hand at the beginning of September, so there is no opening inventory at the beginning of September. Right. So what is the requirement of the question? Required. Prepare profit statements for September 2005 using number 1, absorption costing, number 2, marginal costing. So this question is carrying 18 marks. I hope you are following. Right. So there are 2 stages that you need to follow when preparing income statements for the 2 costing approaches. Right. Stage number 1, you prepare what you call the unit cost statement. The unit cost statement, it helps you to calculate the production cost per unit, which will then help you to convert the units into monetary value. So for absorption costing, we make use of variable production costs per unit plus fixed production costs per unit. It includes both variable production costs per unit as well as fixed production costs per unit. However, the marginal costing, it only takes variable production costs per unit only. It excludes the fixed production costs per unit. So I want you to notice something. In the unit cost statement, only unit costs which are related to production are recorded. It simply means administrative overheads, variable sales overheads, fixed sales overheads are not recorded in the unit cost statement. Why? Because these costs are not related to production. So in the unit cost statement, we have to focus on the 4 given costs which are related to production. I hope you are following. Right. So direct materials, they are part of variable production costs. Direct labor, variable production costs. Variable overheads, they are part of variable production costs. But fixed overheads, they are part of fixed production costs. So I'm going to include all those 4 costs in the unit cost for absorption, since it includes both VPC and FPC. So I have DM, where DM is representing the direct materials. We have 100. I hope you are following. DL is standing at 90. So I'm going to write 90, direct labor. We have variable overheads per unit, which are standing at 50. So I'm going to write 50 here. Then we have fixed overheads. Fixed overheads are amounting to 160. So I'm going to put 160. I hope you are following. Right, so I want to add to find the total unit cost under absorption costing. So I'm going to write 400 here. I hope you are following. So 400 is the total unit cost under absorption costing. Right. Then, under marginal costing, we only consider variable production cost per unit. It means I'm going to take the first three, which is 100, 90, and 50, but 160 is going to be excluded. Since marginal costing does not take into account of fixed production costs. I hope you are following. So I'm going to put 100 here. I put 90. I put 50. Then I'm going to put a dash on the fixed overheads. So if we add, you get 240. So 240 is the unit cost under marginal costing. Right. So after the preparation of the unit cost statement, you need to prepare a quantity statement or a production budget. Right. What happens is, under these questions, there is a missing figure, which can be units produced or closing inventory. Right. So whenever this question comes, right, like in this question, we are given 2,400 units produced, 1,800 sold, but nothing was mentioned about closing inventory. So this production budget or this quantity statement will help you to find or to calculate the units for closing inventory. I hope you are following. Right. So opening inventory, I'm going to put a 0. Why? There is this last statement. There was no stock on hand at the beginning of September. So it simply means that our opening stock is 0. Then we move on to add production. Right, here is the statement. During the month of September 2005, a total of 2,400 units were produced. So I'm going to put 2,400 on production, add it with the 0. You get 2,400. I hope you are following, class. Right, then I'm going to deduct the sales units. Right, of which 1,800 were sold. So I'm going to deduct 1,800 units here from the 2.4. You come out with 600. I hope you are following. So 600 is the balancing figure, which is representing the closing inventory, which was not given by the question. And this is the reason for stage number 2, to find the missing units. Right. So some of the questions, they may provide closing inventory, sales, and opening inventory, but production units will be missing. So they will come here as a balancing figure. So stage number 2 is necessary to find the units missing, either for production or for closing inventory. I hope you are following, class. So I want you to stay tuned as we move on to the next segment, whereby we are going to prepare the absorption costing income statement. Right, welcome back. We are now preparing absorption costing income statement for September. Right. So you are going to start with sales, also known as revenue. I hope you are following, class. Right. So how do you calculate the sales? So you can clearly notice that in our production budget, we sold 1,800 units. So I'm going to multiply 1,800 units sold with the given selling price per unit, which is $800 here. So you multiply this by $800. I hope you are following, class. Right here, 1,440,000, something like this. I hope you are following, class. Right. Then after that, you move on to the heading, less cost of sales. You write less cost of sales. I hope you are following. So under cost of sales, you start with opening inventory. So I'm going to write opening inventory here. Then I'm going to put a 0, right? Since there was no stock at hand at the beginning of September. I hope you are following, right? Then after opening inventory, you add production cost. You add production cost. So to calculate the production cost, it is very simple. You look into your production budget or your quantity statement. You can clearly notice that 2,400 units were produced. So I'm going to take 2,400 units and multiply it with the unit cost, right, under absorption. So remember, we prepared stage 1 to calculate the unit cost under absorption and the marginal. So here I'm going to use 400 since I'm preparing absorption costing income statement. This 400 is going to help you to convert units into monetary value. So the units for production, 2,400, are going to be multiplied by 400, the unit cost. You get 960,000. Something like this. I hope you are following. So if we add with 0, it means you still get 960,000, right? So after that, we are going to deduct closing inventory. So less closing inventory. I hope you are following. So closing inventory, remember, was not given by the question, but we managed to calculate it as 600 in the production budget as a balancing figure. So for closing inventory, I'm going to write 600 units. So you write 600 here, then convert it by 400 per unit. So I'm going to write 240,000 here to be deducted from the 960. So 960,000 minus 240,000. What do you get? 720. So 720,000 denotes the cost of sales. So I'm going to write cost of sales here. The reason why I'm writing the cost of sales in the first column is I want to adjust the production volume variance. Remember, if your question comes with a budgeted or a normal activity level, it means there is production volume variance, which affects only the absorption costing. So how do you calculate the production volume variance? It's going to be calculated by the formula actual output minus budgeted output. I hope you are following. Budgeted output times fixed production cost per unit. Something like this. So the actual units produced here, we are given as 2.4. So I'm going to put 2,400 on actual output. The budgeted output refers to the given anticipated or normal activity level, which is 2,000. So I'm going to less 2,000, representing the budgeted output. Then you have to multiply it by the fixed production cost per unit, which is given in the quantity in the unit cost statement as 160. So I'm going to multiply by 160. I hope you are following. So 2,400 minus 2,000 times 160, you get 64,000. So since the 64,000 is positive, it simply means we have over recovery, which is income. So over recovery is treated in two ways. It's either you treat it as income, or you deduct over recovery from the cost of sales, right? So remember, in our income statement, we obtained the cost of sales of 720,000. So I'm going to less production volume variance. Right, and the over recovery here is of 64,000. Since over recovery is income, it means the costs of 720,000 are going to be deducted by the benefit of 64,000. I hope you are following. So 720 minus 64, what do you get? 656,000. Then you put this figure in the second column. I hope you are following, class. Right. So if you don't want to record 64,000 by adjusting it to the cost of sales, you have another option of recording this 64,000 under the heading expenses. But you have to choose one method. You don't apply both methods simultaneously. I hope you are following. I normally prefer to adjust the production volume variance on the cost of sales figure. If it is favorable, you deduct to reduce the cost. But if it is unfavorable, you then need to add to increase the cost. I hope you are following. So I'm now deducting 656,000 from the revenue of 1,440,000. So 1,440,000 minus 656,000, you get 784,000. So I'm going to write 784,000, representing your gross profit. So this is your gross profit here. You write gross profit. I hope you are following, class. Right. So now that we have the gross profit figure, we move on to the heading less expenses. So we now have the remaining costs, right, which are fixed admin, variable sales overheads, and fixed sales overheads, which did not qualify to be recorded in the unit cost statement. So these costs are now treated as expenses under absorption costing income statement. I hope you are following. So I'm going to start by writing the fixed admin overheads of 80,000. So fixed admin overheads amounting to 80,000. So you write 80,000 here. Then we move on to variable sales overheads. Variable sales overheads are to be calculated using 10% of sales value. So let me write variable sales overheads, something like this. I hope you are following. Then 10% times the sales value. So our sales value was 1,440,000. So I'm going to multiply by 1,440,000. You simply erase 1 0 in front. You get 144,000. Something like this. I hope you are following, class. Right. Then we move on to the last expense, fixed sales overheads amounting to 120,000. So I'm going to write fixed here, sales overheads. Then you record 120,000. So let us add the total expenses here, right? So 80,000 plus 144,000 plus 120,000, you get 344,000. So this 344,000 is going to be deducted from the gross profit of 784,000. You get 440,000. So you write 440,000 here. which is going to represent your net profit. Then you are home and dry. So this is how you prepare the income statement under absorption costing, right? So I want you to stay tuned as we move on to marginal costing approach. So we also start with sales, first, also known as revenue. So the selling price is not affected by the costing approach. Remember, we sold 1,800 units. So 1,800 units times the selling price of 800. We still get 1,440,000. Like what we did under absorption costing, right? Then after that, you write the heading less cost of sales. You write less cost of sales. So you have to take it easy, right? So under less cost of sales, you start by opening inventory, of which the opening inventory is going to be 0, since we do not have stock on hand at the beginning of September. I hope you are following. Then add production cost. So to calculate production costs, you look at your production budget first to identify the number of units produced. So the number of units produced are 2,400. So I'm going to write 2,400 here. These are units, right? To convert these units into monetary value, you then refer to stage 1, which is the unit cost statement. So in the absorption costing income statement, we use the 400. But this time around, we are now using 240, since it is the unit cost under marginal costing. So I'm going to multiply this 2.4 by 240. So you write 576 here, 1,000. Add it with the 0. You still get 576,000. I hope you are following, class, right? So after that, less closing inventory. So closing inventory, under production budget, we have 600 units, which came out as balancing figure. So this 600 is going to be multiplied by the unit cost under marginal of 240. So 600 times 240, 144,000. You write 144,000 here, something like this. I hope you are following. So 576,000 minus 144,000. What do you get? 432,000. You write 432,000 here, right, representing the cost of sales. This is the cost of sales figure. Right, but I want you to notice something. In our previous income statement under absorption costing, on the cost of sales, we adjusted the production volume variance. But marginal costing is not affected by the production volume variance. So we do not have production volume variance, we do not have over recovery or under recovery under marginal income statement. However, the reason why I wrote the cost of sales in the first column is because under marginal costing, variable selling expenses or sales commission are not treated as expenses, but they are added to the cost of sales. I hope you are following. Remember, in our question, we are given variable sales overheads as 10% of sales value. I hope you are following. So we need to add variable sales overheads on the cost of sales of 432. So 10% of 1,440,000, you get 144,000. So you write 144,000. So you are going to add to increase the costs. I hope you are following. So this is 0, 0, 0, 6, 7, and 5. I hope you are following, class. Right, after that, you place this figure in the second column, 576,000, so that it is then deducted from the sales revenue. So 1,440,000 minus 576,000. What do you get? 864,000. So you write 864,000. So 864,000 is going to represent what you call contribution, because under marginal income statement we do not have gross profit, but we have what you call contribution. So you write this figure is contribution. Right. After that, you write less fixed costs. Less fixed costs. Under marginal income statement, all fixed costs are treated as expenses. Be it production, be it admin, be it marketing. Any cost with a tag fixed is treated as an expense under marginal costing. So here we have fixed overheads of 160 per unit. So I'm going to write fixed production overheads first. Then you take the unit 160. But do not multiply this 160 with 2.4 the units produced. You have to multiply 160 with the normal budgeted level of 2,000. So I'm going to multiply it by 2,000 and not by 2.4. Take note of that. So 160 times 2,000, you get 320. So you write 320,000 here. I hope you are following. Right, then after that, we move on to fixed administrative overheads of 80,000. So fixed admin overheads. Then you write 80,000, something like this. Then after that, we have fixed sales overheads of 120. So you write fixed sales overheads. Then you write 120,000. Then you have to add to get the total. Right. But you get 520,000. So you write 520,000 here to be deducted from 864. So 864 minus 520. What do you get? 344. So 344,000 denotes your net profit. Then you are home and dry. So this is how you prepare the profit under marginal costing. Right. So on part C of the question, the examiner may ask you to prepare the statement of reconciling absorption costing profit with marginal costing profit. Right. So here you write marginal. You write marginal profit or marginal costing profit. So under marginal costing profit, our figure was 344,000. So I'm going to put 344,000 here. I hope you are following. Right, then on the total here, you write absorption profit. So I'm going to write absorption profit here. And the absorption profit, we got 440,000. So I'm going to put 440,000 in this total. You write 440,000, something like this. Right. So how do you reconcile? The difference between marginal profit and absorption profit was due to the change in stocks. So I'm going to write change in stocks or change in inventories. So I'm going to do the calculations here for change in stocks, so that I insert a figure here which will reconcile 344 with 440,000. So how do you calculate change in stocks? Here is the formula. Closing inventory, right, times fixed production cost per unit, right, minus opening inventory, I hope you are following, times fixed production cost per unit. This is the formula for change in stocks. So the closing inventory, we calculated it in the quantity statement as balancing figure of 600. So I'm going to put 600 units on closing inventory to be multiplied by the fixed production cost per unit of 160. So you multiply this by 160, which is the FPC, minus opening inventory was 0 since there was no stock on hand at the beginning of September. You multiply by 160. So what is 600 times 160? 600 times 160, it gives you 96,000. You write 96,000 here, minus 0 times 160, you get 0. So 960 minus 0, it gives you 960,000. So I'm going to put 960,000 here, since it came out as a positive figure. You can clearly notice that if you add 960,000 with 344 of marginal profit, you get 440,000. So it means you have reconciled the marginal profit with absorption profit. Right. So this is the reconciliation statement. Then you can be asked to explain. Right. So how do you explain the difference in stocks? Right. So first point, the difference between marginal profit and absorption profit was due to fixed production overheads. Absorption costing included fixed production overheads, whereas marginal costing excluded fixed production overheads in the calculation of the unit cost. First point. Right. Then absorption costing profit obtains higher profit than marginal costing. Why? Because actual units produced, right, exceeded the units sold. You can clearly notice that in your quantity statement or a production budget, that actual units produced of 2.4 exceeded the actual units sold. So if actual units produced exceeded the actual units sold, this gives you a higher closing stock or a higher closing inventory. So under absorption costing, the higher the closing inventory, the higher the profit. I hope you are following. So absorption costing obtained a higher profit than marginal costing. Why? Because production volume exceeded sales volume, making closing inventory to be higher. And the higher the closing inventory, the higher the absorption costing profit. So these are some of the points that you write to explain. I hope you enjoyed today's lesson. My name is Innocent Mapanda. If you are watching for the first time, kindly click the subscribe button below in red. Invite as many people as possible to subscribe to our channel. Till we meet again, Shalom.